Hi guys, it's Henry from Investment for Expats. If you haven't checked us out, we've got over 500 blogs on the website about investing as an expat as wealth protection. And to navigate you through that, it's www.investmentforexpats.com. Today I want to go quickly over structured notes, how they work, what are the logistics and advantages and disadvantages of having them in your portfolio. Firstly, what is structured notes? They're debt obligations issued by financial institutions is the simple version taken from Investopedia. An example of how they would work would be you'd have it linked to, say for example, the S&P 500. If that was issuing at hypothetically 1,000, you'd then buy into that for a 5-year term or whatever the term of the note is, and they'd have provisions in place where as long as it didn't fall 20% at each observation date, normally at quarterly or biannually, it would pay you a coupon of say 2% per quarter, and they'd have a term for 5 years. Normally, can be longer, can be shorter, and as long as it wasn't below the barrier level, normally kind of 35 to 50%, they would pay you back the principal. So you can see how they've become quite popular to take, especially in a low yielding environment where bonds have not really been yielding too much significance. They've took that provision as well. Of course, so that's some of the advantages of structured notes, is they do have a diversification in your portfolio, especially in times of low yielding when bonds. They're not particularly correlated to equities, although they do have an element of an underlying in equities, but they more take of a derivative. The disadvantages of them, they are quite complex, how the bank makes money from them, from example issuing to zero coupon bonds and call options, etc. It's not too much for the retail investors, but it is something to consider, is that they are quite complex how they work. They don't have too much liquidity in them, so like I said before, they normally have 5-year terms. They do have provisions where they can be called early if they're above the strike value, and also they're not guaranteed and they're at default risk by the issuer. So for example, if they're issued by Barclays Bank were to go in the situation of Lehman Brothers, you would then lose your principal as well. So just want to go quickly on why I see them useful in a portfolio and how I've been using them in mine. Firstly, I just want to say they do get a bit of a bad rep, and rightly so. They can have commissions baked into them, so you may not be seeing if you're getting the best rate due to that. Normally, obviously, it's best to go into the clean structured notes on that. So how I'm using them is getting them into the secondary market value. Going in, what you can do is say if it was linked to the S&P 500, now year to date as we're speaking in July 2022, if it was hypothetically for a 5-year one, you'd be getting it at a near 20% discount if it's issued at the beginning of the year or kind of before in late 2021. So you could buy it at a discount of say 20% with a 35% protection barrier, so as long as it doesn't fall. And then you would still get your coupons if it's above the 20% barrier. They normally have features such as memory features. And then as long as if it was above the 35% barrier at principal, you would then get the full 100% of the principal back. So in this case, it would be the extra 20% plus the coupons that you've eclipsed in that time. So let's have a bit about how we're using them in these present market conditions. Again, they are quite, they're not for your normal retail investor. They are used as an alternative in investments. So for the normal retail investor, 5 to 10% max of your portfolio, just got a bit of diversification in there. What are my thoughts on them? I think they do have uses in a portfolio personally. I use them in my personal portfolio. I like the element of they've got some protection there. They do obviously have a lot of disadvantages in terms of illiquidity. They're not for the short-term investor that may need cash or someone retiree. They're more for the growth investor that can afford to take that risk. If you have got any questions, feel free to message me at info@investmentforexpats.com.